thank you very much. Thank you for the invitation to speak here. So my name's Dickie. I'm one of the directors of economics for the environment consultancy, eftec. So hopefully you can guess what we do from that name. So yeah, we're specialists in environmental economics and recent years actually applying those principles through natural capital. So I'm going to give a quick description of what the natural capital approach is, because lots of people have heard of it and don't necessarily know the same version of how it can work, and then give some examples, and I'll try and meet Richard's challenge of tying that to how you actually assess that taxonomy in practice. So what's the big idea? So obviously I've used this picture because it's about a big idea, but also I'm going to give a very simple example to demonstrate why we should be thinking about natural capital, thinking about an apple tree. So imagine a business that manages an orchard, and each year it harvests its apples and hopefully sells them for more than the cost of harvesting them and makes a profit. Now if they only pay attention to their flows of income, and they're listening to their finance team say, we want to increase our revenue, what could they do? Well, after the harvest, just before the March financial year end, they could cut down all the trees and sell the timber. And sure enough, their revenue would go up. But obviously that's not the most sustainable approach to managing a business. And they couldn't possibly be that stupid. I mean, that's not what humanity's doing with fisheries or soils. Well, obviously there's things that are slightly more complicated than that orchard example, but that's exactly what we're doing, right? So we need to pay attention to the stocks of natural capital. And that's the key idea, and this is why this is an important part of the game-changing policies that are coming through at European level. So the natural capital approach, to me it should involve several things. So that first example I've just given, stocks as well as flows are key. You want to look at both. And then you've got to, as well as using different measurement approaches, you need to think about value. Now, as an environmental economist, I would say use monetary values whenever possible. But it doesn't have to be monetary value, but you have to think about value to people. You're going to be forward-looking because capital is about assets that can produce things into the future. So you have to take a forward-looking perspective, and you also have to think about where are we dependent on the environment for benefits, not just what impacts we have. So traditionally, our legislation has dealt with how humanity has had a negative impact on the environment through different impacts of, say, emissions. There's also things about where are we dependent on a good quality environment for our water resources. So those dependencies are key as well. So that's the natural capital approach in hopefully 2 minutes. How can we put that into practice? As economists, the work I do is increasingly focused on natural capital accounting. And the reason we're looking at accounting is we're trying to steal some of the rigor and trustworthiness, sometimes more than others, from the finance sector. Because what the finance sector has is a way of developing comparable information across different organisations and across time. And if you think about it, you can look at businesses anywhere in the world and look at their finances and understand something about them. But you can't do that with environmental information nearly enough. So we want to improve that kind of comparability. So the process we would use at an organisational level for natural capital accounting boils down to these 5 questions. And you're basically saying, what parts of the environment are you responsible for? So you need at that stage a line or several lines on a map saying this is the bit we're managing. Then what benefits does that natural capital produce? Once you've measured what it's producing, you can think about the value of those benefits. And you also can ask yourself the question of what costs are there of maintaining those assets so they keep providing those benefits. So you have a cost side. Now, environmental economics over the last few decades has really focused on the benefits. But actually with accounting, we're realizing there's so much more useful information already in existence about costs. So for example, how do you value that water catchment? But you could try and use non-market valuation techniques, but you could actually just look at a water company's investments and costs and say how much more does it cost when the catchment's in poor condition. Now actually in the UK and England, the water companies can tell you that, but they don't want to because their regulator doesn't give them an incentive to. So we've got information we're not exploiting in various sectors like that. And if you've looked at both benefits and costs, obviously you've got opportunity for a balance sheet. And this is the output of the accounting work we do. Now these examples are anonymised and they're here just to really illustrate the sort of insight we can get from things. So this is a typical format of a balance sheet. Firstly, you'll notice here we've got biodiversity metric, which is something developed in England by DEFRA, so not everything's captured in monetary terms. That's the key metric in this case that's not, so we put it in separate terms. And then you see we divide value into private inside the organisation, so the revenues they get from the natural capital they manage and the costs they have of looking after it. And then you can see the benefits the rest of society get are much greater, and that's typically the case when we look at these things. So that's the nature of the environment. Often the benefits to wider society are larger than the benefits to the private landowner or the manager of the natural capital. So making that explicit firstly is a useful thing. You start to understand something about these types of benefits. Who is it that's benefiting, when and where? In this case, you've also got a very interesting situation that actually these natural capital assets are dependent on spending by other organisations. So actually this is about water companies and flood defence spending that protects the asset involved. Right? So there's quite a complicated set of interactions going on here, and you can start to see that in the balance sheet, and you can start to see that we've got space here to record change over time, in the same way kind of stealing some of the accountant's terms around acquisitions, additions and disposals. So this is a baseline balance sheet, and it's set up with a framework to repeat this accounting process consistently over time. Another way of using this kind of balance sheet is at a project level, which might come through in major infrastructure investments. So here you can see, again, we've got a baseline, and then we've got with the scheme, this is the flood defence scheme, so by far the largest benefit there is the flood protection it offers. But if you look at the cost involved, so they justified using basically some green flood defence measures here, and then that proportion of the cost actually complement each other, the green and the grey infrastructure investment, but they also mean you get these benefits from the natural capital. So you've got to break down those things. And you can see in the balance sheet a positive result. This is a worthwhile investment. But when you design it, actually, so it's justified by this, but you can get a better outcome from the money involved by also realising these benefits. So they're not material to whether the scheme goes ahead, but they're material in deciding the optimal design. The other thing about this kind of framework is it then gives you, it's not time dependent on the age of the scheme, so you can do this in advance, during the scheme, and afterwards. So it's a monitoring and evaluation framework, which already exists in environmental economics, but this is something that I would say is much more recognisable to finance managers who might be organising an infrastructure project. Okay, and then my final example is around forestry, but not the accounts we've produced for Quiltshire, although I will mention those. This is actually one we did for the Natural Capital Protocol Finance Supplement. It's the largest private forest landowner in Europe, a Swedish company, and we did this from publicly available data for them in a matter of weeks. And it's published online through the Natural Capital Coalition. And so this is their balance sheet, and again, this is going back to the sort of private value to the business and value to the rest of the society division. And a few things here. So there's some things that are inside their existing business accounts, although not all these are made explicit. So actually that second point there, this is where they reuse some of their waste to generate energy. So that's actually demonstrating some circular economy activity, which is one of the things in the taxonomy, and putting a value on that through the savings they make by that circular use of material. And also they save costs by producing their own seedlings. But then you can see, obviously, carbon was on that taxonomy as well, so the carbon sequestration benefits of managing the forest. And those wider societal benefits, actually that row, that's mainly a valuation of the habitat they maintain in semi-natural states, so that relates to the biodiversity and healthy ecosystems point. So you can see several parts of the taxonomy being explicitly measured in this framework. And then obviously you can sum those things to give a gross asset value, and here they've got their liability, so their cost of maintaining these assets into the future to keep them as productive forest land, but also to keep them in a state that will continue to provide these benefits. And so, yeah, you obviously add these things up. They have shareholders, so there's some dividends paid to retained earnings, and then you get a net natural capital position. So it's sustainable economy. What does that word mean? And sustainability is maybe the most widely abused term in the environment sector over my professional lifetime. But actually here we can get to one, you're not going to get to just one definition of it. You can get to one way of specifically trying to measure it and saying, are we spending enough money to maintain assets to keep providing benefits into the future? And if we're not, it's not a sustainable position. Okay, to do that, you start asking yourself questions about the future. And as with ratings, they're forward-looking about the risk of default. So you see these values I've been producing are total values here, so they're present values. They're not just an annual value. As I said, an annual flow doesn't give you the right insight. So they're a present value, which is all the values into the future capitalized into a current value figure. Now, if you want to add up those values into the future, you have to have some idea of what trends you expect. Now, economists, as I was brought up, basically just said, well, everything will be the same in the future as it is now, unless we're consuming a non-renewable resource like oil, obviously, or not. Everything else, we just thought that was the case. Well, that's not acceptable anymore. Particularly, it's not acceptable because of climate change. We have climate science that tells us things about the future. We're very clever scientists. How do we translate that into decision-making information? Well, I'd say one way is it shows up in balance sheets like this. So other places we've done this analysis, we can see the benefit of, say, green space cooling an urban environment. And it has a certain value right now. But if you look at the projections on climate change and more heat waves in Northwest Europe, then that value in cities in the UK is going up into the future. So we can connect that climate science to the value of the natural environment. Okay, so a few things to summarise what a natural capital accounts tell us. So identifying key assets and the types of benefits, putting monetary values on those benefits and liabilities. And in the case of culture, we understand something about the relative value of the timber production and the carbon and recreation benefits. And those timber values are slightly lower, but those are the ones that realise themselves as financial returns within the organisation. So that sort of puts numbers on the kind of balance, the trade-offs the organisation is trying to strike. And you've got that division of internal and external values and costs. So that's kind of the headline, but behind that, in doing an account, we understand something about, we're asking ourselves the question, why do natural capital assets provide that value? What types of value and to who? That distribution is really important. So which stakeholders? How are regulators going to react on behalf of those stakeholders in the future? You get an insight into that. And as I said, there's that definition of sustainable management. And then there's a framework you can potentially use to monitor and evaluate performance, because we're trying to set it up in a way that provides consistently over time. And you understand stakeholder relationships, future trends, and with that information, actually, then you start to get into investments, not necessarily in the financial market sense that Richard and Dave were talking about, but we've recently produced an investment strategy for the city region of Greater Manchester, and that was based on, firstly, having a natural capital account for the city region, so understanding the different benefits in terms of, for example, public health to the city, and that basis saying, understanding who's benefiting, then you can start to designing the investments better, because you know who might benefit and what returns might be realised. So thanks very much for listening, and I look forward to your